Morning, Dino. Yes. Yes, we've just 2 nights in the bush, and I tell you what, bush holidays are always good, but after lockdown and like 6 months of the same four walls, I was going to say having a different four walls, but of course you're in the bush, so it's all just bush. Really, really good, and Pilanesberg is an excellent game reserve, close, easy, and just a beautiful place. Well, yeah. When the president was talking, he was still giving his speech, and he said interprovincial travel, and I had booked before he had finished his speech. No chance. And there's some good prices out there. Because obviously everyone's going on holiday, and venues are keen that you go to them and not somebody else. So I've seen some. I mean, we went to a fancy place that under normal times I don't even look at the website, and this time it was still expensive, but it was a whole lot more reasonable because no foreign tourists. They typically cater for foreigners. Yeah. Mm-hmm. Yeah. Yeah. Yes. Yeah, so Tesla, Apple, as you said, we mentioned it. It's effective today, 31 August. So if someone's got either of those shares in their web trader portfolio, they're going to see a price collapse. But then, glance your eye across to where the volume is, and you'll see a volume spike, and it'll all set off the same. You'll be in the same position. Typically, stock splits are bullish, and that in the olden days, and I was going to say you weren't long before you joined the market, but like back in the 90s, before we went electronic, you had to buy shares in units of 100 quantity, and if you didn't, it was an odd lot, and it was extra expensive, and so the price of the share actually made a difference. That's no longer applicable. Now you can buy as many or as few as you want. Sorry, some folks not seeing my screen. Let's try again. Gone and back, should be there. And so, but they're still typically bullish, particularly Tesla, $2,300. Not everyone can afford a Tesla share. It'll now drop to sub 500. So it should be bullish for both, although it doesn't change the business at all. And it will look a little weird in your account for a couple of hours, and then it'll autocorrect overnight and will be looking fine again. But as you point out, this has implications to the Dow Jones. So the Dow Jones is the weirdest index in the world. It is what they call a price-based index. And what that means is that if a stock in the index adds $5, well, they add the equivalent of $5 to the index. It's nothing to do with market cap. It's not based on percentage move or anything like that. And the changing to the index is on an ad hoc basis, whereas your top 40, your S&P 500, they're done quarterly. There's strict rules. The Dow Jones is literally a bunch of people get together and say, oh, we've got a problem here. We need to fix it. And so they're fixing. And those changes will also come in this evening. Salesforce is replacing Exxon Mobil. Exxon Mobil been in the index since 1922. Back then it was called Standard Oil. Amgen will replace Pfizer, and Honeywell will replace Raytheon Technologies. And it's trying to, so the Apple kind of, because it does the split, it reduces the Apple influence in the index. So they want to bring some tech in, that Salesforce, but also it's trying to sort of, for example, taking Exxon out is in some sense a tip towards saying, you know what, hydrocarbons are not the future. They're going to be around for a long time, but at some point, I don't know, 100 years, 200 years, people are going to look back at the use of hydrocarbon and scratch their heads and say, what was this planet thinking? So it is sort of telling in that sort of sense. The weirdest thing perhaps about the Dow Jones is that notwithstanding it is a price-based index, and the craziest way to do it, it actually tracks the S&P really well. Or, the Dow Jones would tell you the S&P tracks it because, of course, the Dow Jones has been around for over 100 years. But even though it's a weird concept for an index, it works. It delivers points. Typically, traders and folks focus on the S&P because it's more broad-based and a better constructed index. But the Dow Jones is certainly a popular and well-known index, and as I said, it delivers on it. So bunches of changes. What we will see is stocks exiting. Exxon, Pfizer and Raytheon Technologies will see some pricing pressure, and those entering see some buying. But there's not that many index trackers that track the Dow Jones. Most of the US index trackers tracking home markets are tracking either the Russell 2000, which is their mid-cap, or tracking the S&P 500. There are very few that try and replicate the Dow Jones. I was digging. I could find two, and neither have significant market cap. So it will have some price issue on those entering and leaving, but not as significant as going into the S&P 500, which interestingly, Tesla might end up in the S&P 500. They meet the requirements, and that will be bullish for Tesla because it means all the index trackers, of which there are literally hundreds of billions of dollars tracking that index, will have to go and buy that share, even if only in small amounts, as it enters into the index. Yeah. Yeah, so I mean, the background here, of course, is a presidential executive order declaring that TicTok must be sold. It was initially 15 September. That was extended by a further follow-up and now runs into October. ByteDance, the parent company of TikTok, have said they're going to court, that the executive order is illegal. And then this morning, while we were sleeping, China time, as they were coming up, the Chinese government is actually putting in place laws around the ability to sell Chinese tech to foreign companies, much as the US has done, particularly aiming at Huawei and 5G. So this gets deeply complicated, but there certainly all reports are that the front runners is Microsoft. Microsoft, I think, wants TikTok not because they want a social media. I think they would probably do what they did with LinkedIn. In other words, they would leave it very much as independent. Microsoft bought LinkedIn and basically left LinkedIn to their own devices. I think what they want with TikTok is to put it onto their Azure platform. It currently runs on, I think it's on the Google Cloud, almost as a proof of concept. To say, look, we can run one of the biggest tech high-use platforms ever. It's video, so the files are large, as opposed to Instagram, where the images are much smaller. And then, of course, Twitter, there's video on Twitter, but a lot of it is text-based, so even smaller. So I think Microsoft wanted it as a proof of concept. So where does Walmart fit in? And I think this is Walmart. So Walmart remains the biggest retailer in America. They've done very well with their online presence over the last couple of years, particularly in India, but also in their home territory. They've got an Amazon Prime competitor where you pay flat rates. They're focusing a lot on sort of the fresh side of the business, largely because they can use their existing store footprint as warehousing in a sense. So I think Walmart probably looking at this as a way to try and almost do it as selling products. Now the question is, are there Walmart products that TikTok users want? I don't know, and truthfully, if not, Walmart can source it. But kind of like on Instagram, you almost got a buy now button. Now, we don't see that much in South Africa because of the territory we're in. But in the US, apparently, sometimes there's, sort of every second or third post has got a buy now click. Instagram does the sort of billing, and then it gets sent to the back end for fulfillment to whoever it is. In the case of TikTok, what Walmart could do is a buy now, and they do the billing process, but they can do the fulfillment process as well. And then interestingly, this puts both Microsoft and Walmart in the advertising business, currently dominated by Google and Facebook. Facebook obviously including advertising on Instagram at the same time. It suddenly puts them into the space of selling advertising. And it's, what's weird about it is that an asset such as TikTok very seldom comes up for sale. Companies such as Facebook were made from scratch. Instagram was purchased by Facebook, but when it was purchased, it had barely 100 million users at the time. We saw Snap turn down acquisition from Google, ultimately list and frankly doing all right for Snapchat. So sort of these large established social networks, this is the first time. MySpace was on sale a while ago, but that is a has-been, and I think sold for like $35 million. This is probably going to be in the $10 to $20 billion range. But I think there's still a lot of negotiating to do. Chinese government, ByteDance, law cases, or threatened lawsuits, etc. We'll see how it shakes out. But it'll be, I think, if Microsoft and Walmart get it, it's not going to be giant for either of them because they're such big revenue and profit drivers already. But it's one of those things that in time could become a significant line item, particularly for Walmart, who I think can do a lot of leveraging off that acquisition. Yeah. Yeah, it's going to be fascinating to see it. And I still think it's a way off. I think they're going to definitely be court cases. And what China's particularly worried about in terms of their new order is the IP that sits within the recommendation algorithm within TikTok. I'm not a TikTok user, but that by all accounts is the sort of secret sauce that TikTok has. And China's saying, hey, as a sovereign, that's our secret sauce. You can't sell it to the Americans, and that just starts to get messy. But we'll leave that to the politicians and the legal experts. Mm-hmm. So ADP is actually an HR company. That's their specializing. So the normal one we talk about, non-farm payrolls, unemployment, etc., comes from the Bureau of Labor Statistics, which is a U.S. governmental organization. ADP, it's a payroll company. What they're actually tracking is they're tracking electronic payments from corporates and the like. So they get a very quick number that comes out. Literally Wednesday is the 2nd of September. This will be August data. They get a very quick and fairly reliable. It's a fairly good precursor to what the unemployment rate will look like when it comes out, which will be about a week later. The key thing around it, you mentioned the jobless claims, which we've been touching on at the top of this show almost weekly since lockdown started. And those jobless claims finally did drop below 1 million, but have gone back to 1 million. We've had now 22 out of 23 weeks where we've seen jobless claims over 1 million. Obviously, back in April, it spiked at north of 7 million. But we also must remember that, back in the 08-09 crisis, the worst week was 685,000. What ADP is going to tell us is how many people are getting back into the workforce, and a million plus, and they're looking at, it might be as high as 1.25 million is certainly what consensus is looking for, is a good looking number. Except that during the month of August, we're almost certainly going to, we saw over 4 million initial jobless claims. So it's still not offsetting. The unemployment rate itself is probably going to pick up and improve a little bit. But we're still in a space where U.S. unemployment is going to be drifting at around the 10% level. That after it, in February hit 3.5, which was the lowest level in absolute decades. So ADP always worth watching. If it misses, if it comes in at under 1 million, the market is going to take it as a very negative. Certainly, we're seeing. I was looking at some data over the weekend. If you look at OpenTable, they do restaurant bookings. Restaurant bookings seem to be back to around about 60% in the US. We've been tracking the Apple mobility data. That, except for public transport, is also back to above pre-COVID levels. Flights, the TSA, who track number of foot traffic through the airports in America, they're the security peeps. They still tracking way down on this time last year, sort of about 60 to 75% down on a year ago. So we're seeing bits improving, and that all intuitively makes sense. Getting your car and going somewhere is totally different to catching a flight, which is different to going out for a meal. And the ADP is going to give us a good sense of how's that the re-employment happening. What hasn't happened is, remember the CARES Act, which all expired at the end of July. That has not yet been replaced. There was lots of talk. Trump issued executive orders, but they haven't been implemented because simply they can't be. He doesn't have that level of authority. Congress, the House and the Senate, have not come to any agreement. So there are a lot of people who were getting CARES, Paycheck Protection, etc., and that remains gone. That has now been gone for it'll be 5 weeks on Friday, and that is certainly hurting a section of the U.S. workforce who lost in some cases multiple income streams in a household and aren't getting government support. So the ADP is important to show that there is at least some level of employment. But as I said up front, we've got to view this number in light of the U.S. initial claims, which ran at about just under 4.5 million for the month of August. Yeah, it's a long journey home. Hmm. Yeah. Yeah, and if let's go back to 2007. I mean, Apple had they hadn't yet released their iPhone. They were still a company that they had the iPod that was very successful, but their biggest product remains the iPhone, and they hadn't yet released it. Google was listed and was doing okay, but the jury was still out. And look, the jury was wrong. Google was a solid company, but Facebook was available, but only on college campuses. Twitter came, I think, in 2008 or there's about. So there wasn't, Yahoo was still listed, and I was going to say an exciting tech stock. I don't know if it was still exciting, but it was definitely listed and one of the biggies. And I think it tells us, I think there are two stories to this. The one is that absolute rise of US tech, and we've talked a lot about it, and a lot of it is underpinned by earnings and valuations. Amazon is doing incredibly well. Microsoft, Facebook, Google. Apple has become expensive. It's now in a PE north of 30. A while ago, a couple of years ago, it was a PE in the mid to high teens. It's no longer a cheap share, but they're not sort of a Tesla PE levels yet, and they certainly are generating really, really good revenues. The other side of the equation is what the heck has happened to Europe. And the short answer is that Europe just really hasn't at any point properly recovered from the crisis of 2008, 2009. And particularly the banking sector, they're giant big banks, and the most famous there, of course, is Deutsche Bank. It's just never really got back to sort of their glory days in terms of business, but also in terms of share price. And Europe, seen as a manufacturing hub with Germany very much at its core, it has some tech, but it Process. One of the reasons Naspers listed Process in Amsterdam was because Process then becomes the biggest tech stock in Europe, and in fact the Eurostoxx 50 is going to be doing their index changes in the next day or two, and Process will probably be included in that Eurostoxx 50, and what we get is a region. And as a region, Europe is the second largest economy in the world. The US, Europe, then would come China and Japan. It is significant, but it's just struggled in parts from a business perspective, but struggled all over from a share price perspective as money has moved into the US and more recently into US tech stocks. And then the question is Europe undervalued? And the consensus wherever I go and speak to folks, I was chatting to some of the global strategists from BlackRock about a month ago or so, and their view was, Europe is massively undervalued. But they preface that by saying, you know what, to be true, we've been making that statement now for 5 years. The fact that something's undervalued doesn't mean it's automatically going to start, seeing its value. And that is the problem with Europe. There is a large amount of very cheap assets there, but no one's rushing off to buy them. Post the 2008-09 crisis, I remember when we had the Greek crisis and the pigs, Portugal, Ireland, Italy, Greece, and Spain, and they've largely been resolved. They're not, the perfect, most upstanding sovereign citizens, but there's still just concerns around Europe. There's still cheap valuations. And the point was something that's cheap, which is always great. The question then comes, well, it's cheap, but at what point do prices start to move in our favor? And the answer to that, quite simply, is I don't know what drives European markets higher. If they, at some point in hindsight, we'll say, oh, look, it's been happening. But I'm not quite sure when that hindsight will happen. If you're looking at the European ETF from Signia, I mean, it's in the last 5 years, it's up. Oh, I mean, it's up the tiniest of bits, like, maybe 12 or 13%. And that also has an impact of a weaker currency. So it's probably actually just closer to flat. Yeah, Wirecard. Yeah, and you make a great point there, Danae, that while the argument to bide your time is a solid argument. And yes, you get paid dividends in the meantime. And there's some great dividend yields in Europe, 3, 4, 5, 6, 7% in some cases, and defendable dividends, these not Wirecard type dividends. But it's hard to do when you look across and you see other markets, most notably, the US doing spectacularly well. And truthfully, we're human, and FOMO fixing, that fear of missing out is real. And it's hard to hold those positions. And as you mentioned, regulatory, and then suddenly it's a case of, well, let me go to where it's happening. And when Europe starts to happen, and these days it's easy enough to then get back into Europe. Yeah. Yeah, I mean, that's exactly the point here. I mean, so it was DDoS attacks, shut down 4 times over the week. New Zealand's not a giant exchange, but that the size of the exchange doesn't change it in any sense. And a DDoS attack is not the easiest thing to defend against, but certainly is possible. Low orbital cannons are script kiddie type thing you buy on the interwebs for literally dollars, and you can aim it at websites, but most websites will be able to defend against it. To me, it was less about poking at New Zealand's exchange, and more just remembering that our JSE, which in March and April set records that were in some cases almost double what previous records were, and kudos to Leila Fourie and her team that the exchange stayed up. It carried on working through all of that, volatility auctions left, right and center, massive price movements, huge volume going through, and our exchange worked. And we don't notice it because, well, we expect the exchange to work. Of course we do. We only really notice when it breaks, and then we all jump up and down. But it is certainly a threat, particularly for critical infrastructure, which exchanges most definitely are. Power grid would fit into that, and others as well. But in a sense of their preparedness for cyber attacks, because this is something I think we're probably going to see more attempts at as the future goes on, the exchanges are commenting very little. Other exchanges don't want to have anything to say about the New Zealand. I spoke to some cybersecurity experts, and their view was that it's something which the average exchange probably has in terms of working against it, but that it is something we need to be cognizant of, investors, that there are risks, and even if they're tiny, there's risks of exchange having cyber attack issues, and it might not be a DDoS, it might be a social engineering where a ransomware or something. We saw Garmin shut down back in July due to a ransomware attack. This is very real threats out there for services that, as I say, we don't notice when they're working because we just assume them to, and then suddenly something happens and they sort of disappear off our radar as they sort of fix up their problems. Yeah. Mm-hmm. Yeah, I like that because, I mean, when we think tech, we think the Apples and the Googles and the Facebooks, but actually there's some solid, in South Africa, we've got ISA who does a lot of work with the banks around that space. Etion has got a company called Law, and now I forget the second half who do some in this space. There are some smaller stocks who and particularly, it was a business that they were always working in, and then of course suddenly it became so much more important, sort of as lockdown came with remote work and everything, because remote work adds a risk. Capital appreciation is another one, relatively small, but doing very well on the security aspect. EOH has obviously got a fair bunch in that space as well. Bytes Technology UK will be listing out of Ultron in the next, I'm expecting it later this year, but as I say that, I realize tomorrow is September and maybe it's only the year's running down. But they will be spinning out their UK Bytes operation, which has also got a fair bunch. And I think, as much as an example, in the property space, logistics has done incredibly well, whilst a lot of property has not. In the tech space, cybersecurity is one of those spaces which is hugely important and only going to become more important as we get more and more technologically focused. Mm-hmm. Yeah, and I mean, there are a bunch of moving parts here. You mentioned the provision they set aside for COVID-19. I can't help wondering if maybe they haven't over provided for. And certainly the pandemic, as it has played out in South Africa so far, and I stress the so far part, has not been as bad as many of the epidemiologists and expert statisticians expected. So, does that mean that perhaps Discovery, put aside too much? Maybe, but it'll be not this set of results. It'll be another year, maybe two, before they fully make that decision, because the pandemic's some way to go until it is fully behind us. And, there'll be other small bits as well. I wonder perhaps how their vitality is looking, because people weren't able to go and earn their points from attending Virgin Actives and the like. So, how does that play out in a sense. So that's going to be interesting to see at the same time. They've also got provisions, and what's hurting them is they've written policies where they're basically underpinned with floating interest rates, and interest rates, particularly in South Africa, have come down. That is hurting them as well. Discovery is always complex. I own the share, and you know what? The results, aside from the fact that they truthfully hurt my head when I try and understand them, the results are still important. But to me, it's, Discovery to me has been the bigger picture, and it's that what Adrian Gall's trying to do, which is that bigger holistic sort of behavioral change, which they started in health with Vitality. It worked. They're looking at banking. They sell Vitality into North America. John Hancock, one of the biggest long-term insurers in America, is using Vitality, and now when they sell you a policy, they want you to have a smartwatch so they can check steps and exercises, etc., etc. Puan in China is, and I think the pandemic has probably driven private insurance in China, which 10 years ago was totally unheard of. So the market did not like the update. But a company like Discovery is going to find it tough going in a pandemic, and I still think there's some really quality businesses within the broader Discovery stable, and the stock could run hard. I mean, if I take that chart out a little bit further, it's well down on the highs of 2018, but it's pretty much at the levels that it started this year at, and doubled off the lows of under 60 back in March of this year. Mm. Mm-hmm. Yeah, I mean, I think Discovery almost certainly won't be paying a dividend. Liberty, obviously not at all. They swung into a loss. That loss was purely, as you say, on the back of provisions. And I think, aside from the fact that we're in the first pandemic in 100 years, so the actuarial models they don't have the pandemic parameter. There isn't the tab where you click that says pandemic. So they're flying blind, and make no mistake, they're the smart people. They can manage this. But I think the temptation, and I think it is the correct temptation, is probably to err on the side of caution. Let's rather provision too much. Let's rather, during the heady days back in June, when Discovery was making provisions, Liberty, etc. The market's accepting. You come to market and you say we've got a 2.5 or 3.5 billion rand provision. The market's like, well, yeah, that kind of makes sense. Rather than come and say we've got a 1 billion provision and then have to come back in a year's time. So I think probably what we're going to see, and this isn't going to happen until probably the 2021 or even the 2022 financial years, when they can come back and they can say, look, we over-provisioned. We weren't sure. We went cautious. We put aside too much, but no worries. The money's here and it can now come back into the system. So I think there probably has been over-provisioning, and I think in this case it's probably been the right response from the large insurers and sort of medical insurers. Mm-hmm. Yeah. Yeah, so I mean, Tashas they actually bought in 2008. I hadn't realized it was so far back. And then around 2015 or so, they started. Kevin Hedwick was still CEO. It might have been a year or two earlier, and they started talking about casual dining, sit-down dining, because typically what they've got is the quick service restaurants, your Steers and the like, Debonairs. Then they've got what they call quick dining, which is sort of your Wimpies. And they didn't really have that sort of casual sit-down dining, which is it's a very different business model, but it's a nice margin in terms of the foods you're selling. Of course, it includes alcohol, which is a really good margin business. But the flip side is it's more niche. It requires a lot more space, a lot more staff, etc. So different model, and I really liked it as a Famous Brands shareholder. I thought this was a really good potential, and they did a lot. They some of the brands they've got, they've got Vovatello, they've got Lupa, which is Italian, they've got a Mexican salsa, they've got Turn and Tender, and whole bunches of others where they took 51% stakes, they left the founders with 49%, and then kind of rolled them out, calling them their signature brands. But what we've seen with those signature brands is it just hasn't worked as they'd hoped. And in fact, Famous Brands has reported over the last couple of years that their signature brands aren't delivering the levels of profitability that they'd been hoping for. So that then raises the question, is this now sort of the beginning of the end? Will they be looking to get rid of the rest of those brands? Mythos as well, the Greek one. So do they look to then sort of exit this as a concept and either sell those? Typically, it was a 51% stake, sell it back to the founders, or perhaps find a third party to buy that stake. And I think it probably is. I think a lot of the synergies that they had hoped for, particularly around central kitchen and distribution, didn't quite happen. If you go to a Debonairs, a Wimpy, a Steers, you're probably getting the same serviette, just with a different logo, and Famous Brands can manage that centrally. But if you're going to a Vovatello or a Turn and Tender, it's fundamentally different. It's smaller quantities. It's very much more bespoke. And I think they just haven't got it to work to that degree. So I think probably this is going to start to be not the unraveling, but the reversing of that trend from Famous Brands. And my view is quite simple. I'm happy for companies and corporates to try some new things, but what's always important for me is that when it fails, that they accept that failure, and that's very important to me. Don't carry on trying and trying and trying. Accept sooner rather than later that this isn't working, and rather back out. I remember mentioned Discovery again. Adrian Gore tried to go into America in the early 2000s. They spent R1 billion on it, and it didn't work. And he turned around and said, you know what? Rather spend R1 billion than R2 billion, and it still doesn't work. And I think that's the view that Famous Brands is taking here. So kudos to them. They tried it. It would have been great if it worked. It hasn't. Rather back off than pretend you can make something that patently hasn't worked actually work. Mm-hmm. Yeah. Yeah, I agreed 100%. I think COVID probably, without COVID, they might have, mainly tried a couple more years, but I think COVID has absolutely made them, forced that decision on them. Mm-hmm. Yeah, so your point in first round, they will have full year numbers, and there was a little bit later. Nedbank, ABSA, Standard, Orba, mid-years to June. Standard Bank were the standout results for me. I think Standard Bank's probably going to be the first to reintroduce dividends. Remember, the Prudential Authority asked the banks to please pause dividends, which they all did. I think Standard Bank, I mean, it's not impossible that for their year end, which will then be released in March, perhaps they do a smaller dividend, but perhaps a dividend. But certainly, if not the year end, certainly I think mid year for 2021. What stood out for me, the operations into the rest of the continent, I think Standard Bank's got the edge in that space as well. I think they've got a better business into the rest of the continent. Nedbank, of course, doing a quasi JV, and ABSA having taken over the Barclays business, and the challenge they've the Barclays, that divorce process is largely behind them, but now they've got to go through all the rebranding into the rest of the continent. That's going to be a tricky. It's something that's perfectly possible to do. The marketing people are smart in that sense, but it needs to be done, and they need to communicate that you knew Barclays and now you know ABSA, and don't worry, it's all kind of the same. Two things that really stood out, well, three things that stood out for me of the results we've seen so far. Standard Bank said they were in a position where they could have paid a dividend, but they deferred to the Prudential Authority and didn't. ABSA and Nedbank were not able to pay dividends. All three hit by bad debts, no surprise. All three have provisioned extra money in case of the bad debt still coming. That makes no surprise. What struck me was ABSA made a comment where they said they're expecting H2 bad debts to actually improve, and that surprised me because I really thought that with a lot of the loan payment holidays and the like, if anything, the risk was that bad debts might actually worsen in the second half. But my sense is that the banks have been very aggressive in their writing down bad debts and the like. So ABSA is saying that they think second half will improve, which would then probably be the same for all of the big banks. But that then coupled with a statement from Mike Brown where he says, stating the obvious, that obviously your certainty of predictions in this environment is at the lowest he's ever experienced. In other words, they're cautiously optimistic for the second half, but there are no guarantees whatsoever. Yes, literally anything. Yeah, exactly. Yes. So in many cases, and City Lodge was the extreme, but many of the BE plans that are out there, and many of them start to expire around about now, some of them running a couple more years, but they were set sort of around the World Cup or maybe a few years before. And in a lot of cases, what we found is that those schemes are now underwater. In other words, they're not solvent, and so there needs to be either dissolve them or cash inject affected. In the case of City Lodge, they raised money. In the case of Italtile, they're actually able to manage this internally and sort of transfer the cash across. What struck me with these numbers, as you said, everything around 20% down. They're continuing with their capex of about 800 million a year, which is actually a good thing. You don't want to hold capex because you get sort of left behind and things get sort of old and fragile, and your competitors can overtake you. But I can't help wondering if there isn't something in this home improvement. If you look at Home Depot and Lowe's in the US, they've done incredibly well. We mentioned up front, during lockdown, staring at the same four walls, and suddenly you want to change your tiles. We've seen a lot of people, particularly in the housing market, sort of sub 1.5 million. We've seen a lot of purchasing activity happening in that section of the market, and people are going to want to spruce up their new homes that they've purchased. In some cases, spruce up their homes that they're selling. And I also think that with the work from home, and we'll see in time how long this goes for, but we're 6 months in, and I think a lot of people are making some changes and maybe converting bedrooms or outside rooms or whatever the case may be, maybe moving granny somewhere else and turning her cottage into an office or something. So I think this sort of home improvement / DIY space, I think, is one worth watching. I think they're well positioned to recover in a hurry. They were hit hard by the pandemic, absolutely they were, but I think they're well positioned. The one caveat, of course, is consumers under pressure. We're going to see chronic unemployment in South Africa. There's still people who are not at their normal salaries, on reduced salaries, and still people who lost jobs during pandemics who haven't yet been re-employed. But it's a sector that I'm digging through, and this is one of the few. Most of them, there's some sitting within sort of other, most notably within Massmart, but there's Italtile, and then of course there's Cashbuild. Cashbuild doing a giant deal to buy the Steinhoff business in terms of, and Cashbuild perhaps a little more breadth, whereas Italtile perhaps a little more focused. But I think they're a space that could come out of this pandemic fairly quickly and return to sort of normalization and, in fact, improving profits. So those preference shares are a weird thing. They were listed about 5 years ago. They expire in 5 years' time. Each preference share is underwritten by a Northam share. So it's 1-for-1 and can be converted into either cash or into shares, and that's at Northam's discretion. And it pays interest at prime plus 3%, so really impressive interest rate. And I'm trying to remember the code here. Is it popping up? And what we've seen with it is it doesn't pay the interest directly. The interest gets built into the share price. So the share price has been very steadily from 40 Rand back in 2016, now doubled in value. But this naturally sits as a liability on the Northam balance sheet. So what they've done is they're taking free cash flow and they are generating cash flow by the hand over fist, no surprises. And they've bought back some 46% of these preference shares, which means two things. It means you've got a big buyer for them in the market. But the second important point is it also means that they've reduced the liability. And they've said they plan to continue buying back. I suspect that if they can, it might get to the point that they will buy all available for script that in the market. Obviously, if you don't want to sell it, then you don't have to. But if you want to sell, I think you've got yourself a steady buyer. And they just look at it and think, you know what, prime plus 3%, man, that even with prime at these levels, that's currently running at 10% a year. That's a nice return to shareholders. The results in of themselves, no surprises, really good. Hit hard by COVID, shut down, but they mostly back at operating. Their PGM basket's about 60% platinum, which unfortunately platinum's the metal not doing so great. But an interesting chat with the CEO, and he was commenting something that's been scratching my head is how come the PGMs have held up so well, particularly during lockdown when vehicle sales have disappeared. And his argument is that, and he uses rhodium as an example, is that in 2015 the average catalytic converter using rhodium used about 0.3 and grams, and that's now gone up to 0.45. In other words, it's going up 50% over that 10-year period. So whilst let's assume that vehicle sales stay the same over the period, and they're not going to, they will tick up as well, although not in 2020. The demand for rhodium is up 50%, just that simply. And one of the things was, retooling factories. The cost of the PGM to the motorcar manufacturer is maybe $50. Maybe it's $100, and if you retool to platinum, it might drop to $50. You're selling a car for $10,000, saving $50 for the cost of retooling that factory, for the cost of downtime on that factory, and of course, if everyone switches to platinum, the demand reappears there. So my sense is that the PGM run, notwithstanding vehicle sales falling off a cliff this year, the PGM shortage and going forward looks solid and seems to be well in place, probably at least for another 3 to 5 years to sustain current price levels, if not see those price levels higher, which of course plays into all of our PGM miners, Sibanye-Stillwater, Implats, Anglo Platinum, and Northam being the big four. Yeah, if I pull up the Standard Bank rhodium, I mean, that thing has gone from like 1,000 to 20,000 over 4 years. So it wasn't, double quick time. Although that's pretty quick for a 20 bagger. But you're 100% right. That's helped by Rand and helped in large part also just by a rhodium price that's gone absolutely crazy. And again in August, I mean, the August close for the August, assuming it closes there today, is going to be an all-time high for this ETF. Yeah. Yeah, I mean, it was a tough year for them. As you said, there was definitely some green shoots. They've pivoted out of sort of traditional civil engineering, specializing in oil and gas. Those long-term projects, Henry Last CEO commented that, they did lose 2 projects, but they were relatively small. Typically, if you're building oil and gas infrastructure, you're not looking at today's price. You've got a much longer-term view. The reason I wanted to chat around it today, because of course results are coming at us thick and fast. We could talk results until Wednesday. We chatted about Afrimat last week, and particularly in the relationship to buying the Kozar asset. But I wanted to, and Afrimat as a potential for infrastructure spend in South Africa. Mine and Robert still have their power and water division in South Africa. It's the only real South African division left. The power, and it made some profits, but an absolutely tiny amount. Henry Last CEO says, look, they're going to keep it. And the key reason is because of that infrastructure. Now, on the power side, their two big projects were Medupi and Kalisa, and they were both now, for Murray & Roberts, that work is now completed. Obviously, they can do some work in the renewable energy, but those will be significantly smaller projects, and we're still waiting for the minister to sign off on it. But they're really interested in the water side. A lot of water infrastructure needed to be done. It's an easy win for government in terms of infrastructure spend. It's good for communities. It's good for labor participation. And Murray & Roberts are taking the view that they expect to perhaps be able to pick up a lot in that space. They're not seeing much in the tender activity yet, but they're going to keep the division going as long as it's not loss making. And that's partly you want to retain the skills, you want to retain the expertise on the ground, with the expectation that it will come back. Now, at this point, we could almost say that their local infrastructure was practically zero in terms of what their overall business is. But if the infrastructure spend in South Africa returns and Murray & Roberts wins, some significant contracts, it could pick up to as much as a quarter for the business, and that's not insignificant. So it's not a pure play which you would get with Afrimat obviously being a much purer play in local infrastructure, but it is a way to look at it along with the other one in this space is probably and the name has just completely escaped my head as I was about to say. I wanted to say Esau Robex. That's it. Robex. Robex is the other who I think are very well positioned for South African infrastructure spend. Mm-hmm. Yeah. Yeah, I agreed 100%. And it's our construction sector these days is actually mostly private. A lot of it has just disappeared and in some cases gone bankrupt over the last decade. Yeah. Yes, downhill since. Yeah. I think so. This tech is absolutely amazing, and Elon Musk is a brilliant man. But I think Elon should read the room and check the calendar. And maybe in 2020 he could have put this on hold for 6 months to a year. I think he might be pushing his luck. I worry with you. The sci-fi movies are great fun, but I want to keep them in the theater. I don't want them running down my street. No. Yes. Yeah, in many cases we live in the future. We just forget that because right now we live in a pandemic. Cheers, Danae. It'll be spring. Bye.